Welcome back to the Deep Dive. Today, we are cracking the code on something most people find, well, pretty intimidating. Accounting.
Yeah, it gets a bad rap.
It really does.
Yeah.
But forget the dense textbooks. We're aiming to give you the, let's say, the cheat sheet. We're
Yeah.
calling this financial literacy as a superpower.
I like that.
Our mission, pretty straightforward. Take you from maybe zero understanding to feeling confident with the basic language of business so you can actually, hold your own in meetings or when looking at investments.
That's absolutely the right frame. True mastery, it doesn't matter if it's Kobe Bryant nailing his footwork or a CEO understanding a balance sheet. It's always built on getting the fundamentals perfect.
Right.
So today, we're building that foundation. Brick by brick, we'll cover the core equation, how things are organized, the basic mechanics.
The nuts and bolts.
Exactly, the nuts and bolts. By the end, you won't just know what the numbers are. Hopefully, you'll get why they matter.
And to make this really stick, we're grounding everything in one specific place, a country club business.
Good example.
Think about it, right? A club's got everything. Recurring membership fees, those up and down food and beverage sales, a retail shop,
Your push-up, yeah.
plus huge costs like maintaining the golf course. It's complex but also relatable. A perfect place to test drive this new superpower. Hashtag TakeTag decoding the language in the arena. Okay, so let's unpack this. If we strip away all the jargon, all the complexity, what is accounting? Like at its absolute core.
It's the language of business. That's the simplest way to put it.
Okay.
It's the systematic process. You identify, record, summarize, and then report financial transactions.
So it's like the official translator for money stuff.
Kind of, yeah.
Yeah.
If a business is telling a story through its actions, its monetary actions accounting translates that into a standard script. So stakeholders, owners, investors, whoever, can read it and understand the company's financial health.
Got it. So the business is the arena where the story unfolds. We've got that. But I think where a lot of beginners get, hung up is figuring out the difference between what the business does day to day and what the accountants are actually doing.
That's a really critical distinction. Think of operations, right? That's the engine room.
Doing the actual work.
Exactly. Serving a meal in the clubhouse, giving a golf lesson, mowing the fairways. Those actions generate transactions.
Okay.
And a transaction is just any event that has a financial impact, like getting a member's payment or paying the greenskeeper's salary.
So the activity leads to a transaction, which is a money event.
Precisely. Then accounting steps in. It acts as the official historian.
Moving backward.
Purely backward-looking. It meticulously tracks what has already happened. Now, finance, that's different. Finance is the forward-looking strategist.
Planning ahead.
Right. Planning, managing resources, figuring out cash flow for the future. So operations makes the numbers happen, accounting records the history, and finance uses that history to plan the future.
Okay, let's think about starting our country club. You need resources, right?
Okay.
Buying that land, building the clubhouse, that takes serious cash. Where does that initial money, the capital, come from?
Well, no matter the size of the business, the funding essentially comes from two main places. These are the sources.
Okay.
First, you've got capital, or what's often called owner's equity. That's your skin in the game.
The owner's own money.
Right. The money invested by the founders or owners. Second, you have liabilities. That's money borrowed from outside parties, think bank loans primarily, that you absolutely have to repay.
And that relationship between what you own and where the money came from leads us straight to the central law of accounting, right?
It does, the accounting equation.
Yeah.
Assets, capital plus liabilities. And this isn't just some abstract formula. It's reality.
It has to balance.
Always. Everything the business owns its capitals. Assets must be perfectly matched, dollar for dollar, by where the funding for those assets came from, either the owner's capital or borrowed liabilities. Think of it like a perfectly balanced scale. It has to balance.
So if our club owns a $10 million golf course, that $10 million had to come from either the owners putting money in or the bank lending it.
Or some combination, yes. Exactly.
Okay, let's nail down these terms for our country club. What counts as an asset?
An asset is basically anything the club owns that has future economic value. So the obvious physical stuff, the land, the clubhouse itself, the fleet of golf carts.
Tangible things.
Tangible things, yes. But crucially, it also includes non-physical things, like cash in the bank, and a really important one called accounts receivable.
The money people owe the club.
Exactly. Money owed by members who, say, charge dinner to their account or haven't paid their monthly dues yet. It's an asset because the club has a legal right to that cash eventually.
Makes sense. And liabilities, what are those for the club?
Liabilities are the club's present obligations to external parties. So definitely the big bank loans, probably long-term ones, but also short-term debts, like accounts payable. That's the money owed to suppliers, maybe the food distributor for last week's delivery, or wages payable to salaries staff have earned but haven't actually been paid yet, maybe due this Friday.
Okay, so the equation shows that everything the club has, assets, is perfectly funded by either the owner's capital or what it owes, liabilities. It's this inescapable symmetry.
Elegant, isn't it? It always works. Hashtag tag the dynamic health check, P&L.
Right, so the equation gives us this snapshot, a
Yeah.
picture at one point in time. But how do we know if the club is actually, making money or losing money over a period like a year? We need something more dynamic.
Exactly. We need to measure performance over time. And for that, we introduced two new elements, revenue and expense.
Okay.
Revenue is the total money generated from the club's main activities. For our club, that would be things like membership dues, hopefully a steady stream.
Right.
And then more variable income, like from food and beverage sales, anything sold in the pro shop, maybe lesson fees from the golf pro. It's the lifeblood, really.
An expense, that's the cost of generating that revenue, right? Keeping the lifeblood flowing?
Precisely. Expenses are all the costs you incur to make that revenue happen. Payroll is usually a big one. Utilities, think of the water bill for irrigating the course.
Huge, yeah.
Maintenance costs. And we need to single out one really important expense type. Cost of goods sold, or COGS.
COGS. Why is that one so crucial to track separately?
Because it directly links the cost of what you sell to the revenue you get for it. So if the club sells a steak dinner for, say, $50,
Yeah.
COGS isn't the chef's salary or the electricity for the oven. It's the actual wholesale cost of the raw steak, the potatoes, the spices used for that specific meal.
The direct material cost.
The direct cost of the things sold. Tracking COGS helps managers know if they're pricing things correctly just to cover the basic ingredients or merchandise cost.
Okay, so revenue and expense combine into the main scorecard. Profit and loss. Revenue minus expense? Simple enough.
Right. Profit if revenue is bigger, loss if expense is bigger.
But here's something that trips people up. We hear about companies showing a big profit on their P&L, but suddenly running out of cash. How does that happen? If you have profit, shouldn't you have cash?
That is a fantastic question, and it gets right to the heart of accrual accounting versus cash flow. It's a critical difference.
Oh, okay.
See, the profit on a P&L statement includes money the club earned but maybe hasn't physically received yet. Remember, accounts receivable.
Right, the members who haven't paid yet.
Exactly. You might show come on, that revenue is earned. But if none of them have actually paid their bills, you might have zero cash in the bank to pay the grounds crew this week.
Wow, okay, so P&L tracks earning, not necessarily cash in hand.
Correct. P&L is based on the accrual concept, record revenue when earned, expenses when incurred, regardless of cash movement. Cash flow tracks the actual physical movement of money. They're related, but distinct.
That makes the link back to the main accounting equation even more vital then. How does this P&L performance, this profit or loss, connect back to that static balance sheet equation?
This is the real aha moment, connecting the two. The profit or loss from the P&L directly impacts the capital part of the equation.
I think so.
If the club has a profitable year, that profit belongs to the owners, right? So it increases their stake, increases the capital account. If the club has a loss, unfortunately, that reduces the owner's stake, decreasing capital.
Ah, okay, so the performance feeds back into the ownership value.
Exactly. So our refined equation really looks more like assets, capital plus profit loss, plus liabilities. The performance over time constantly updates the club's overall financial position shown on the balance sheet. Hashtag the pillars of classification and organization.
Okay, so our club has thousands of transactions happening, selling drinks, buying fertilizer, paying salaries. We need a really solid system to categorize all of that neatly. What are the main buckets?
We use 5 fundamental types of accounts, and there's a handy mnemonic to remember them. Balance. Yep.
Asset, liability, income, which is revenue, capital or equity, and expense. Every single financial event, absolutely everything, fits into one of those 5 categories.
Okay, Alice. Asset, liability, income, capital, expense. Got it. But within asset, for example, you have cash, you have accounts receivable, you have golf carts. How are those organized?
That detailed organization is called the Chart of Accounts, or COA.
The COA.
Think of it as the club's financial blueprint. It's a complete list, logically numbered, of every single specific account the business uses, like 10 cash and bank, 1,200 accounts receivable members, 1,550 golf carts.
And the numbering isn't random, right? There's a system.
Absolutely. Standardization is key. Usually, assets start with the number 1, liabilities start with 2. This helps group things logically.
Okay, wait. If we use Alice to remember the types, ALICE, the numbering doesn't quite follow that order. L is 2, but I, income, comes later.
You caught a really important detail there that often confuses people, while Alice is great for just remembering the 5 types.
The actual numbering system is designed based on how the final financial reports are built. Assets, 1, and liabilities, 2, come first because they are needed for the balance sheet.
Okay.
Then, typically, income revenue accounts start with 4 and capital equity accounts start with 3.
So 4 before 3, that seems odd.
It seems odd initially, but it makes sense structurally. You need to calculate the revenue for and expenses, usually 5 and up, first to figure out the profit or loss. Then that profit loss result flows into and updates the capital 3 account, so the numbering reflects that calculation flow.
Ah, okay. The calculation order dictates the numbering, not the Alice mnemonic. Makes sense. And for a place like a country club with different parts, golf, food, maybe tennis, being able to see costs by department must be crucial.
Absolutely essential. A good COA allows for departmentalization. Often you'll see fixed-length department codes added to the account numbers, especially for income and expenses.
For example.
Well, you might have account number 5,000 for employee salaries, but maybe it's coded as 10,500 for food and beverage department salaries and 25,000 for golf operations salaries.
Got it. So you can see the total salary cost easily, but also instantly pull up just the F&B salary cost versus the golf salary cost to compare them to their budgets.
Exactly. It gives management much better control and insight.
All right, now we get into the engine room. We have the blueprint, COA, we have the categories, Alice. How do we actually record transactions to make sure that core equation, assets, liabilities plus capital, always stays perfectly balanced? This is the famous double entry system, isn't it?
It is, and the core idea is actually pretty simple. Based on that balance, every action has an equal and opposite reaction, right?
Yeah.
So every single financial transaction must affect at least 2 accounts, and it must do so with equal amounts on both sides of the effect. We call these 2 sides debit and credit.
Okay, debit and credit. This is where the jargon can really trip people up. They don't mean good and bad or plus and minus in the way we normally think, do they? The source material had this rule. From is credit to is debit. That feels abstract.
It is abstract, and honestly, that from Toto rule can confuse more than help sometimes. Let's try to ground it differently. Think of debit, often abbreviated doctor, as simply the left side of an account or transaction, and credit, CR, as the right side.
Left and right. Okay.
Now, the rules for how debits and credits affect the least accounts depend on where those accounts naturally sit in the main equation. Assets equal liabilities plus capital.
How so?
Assets are on the left side of the equation, so to increase an asset account, you make an entry on its left side. You debit it. Expenses also effectively reduce owner's equity, which is on the right. So increasing an expense also requires a debit.
Okay, debit increases assets and expenses. Left side things.
Right. Now, liabilities and capital are on the right side of the equation. So to increase a liability or a capital account, you make an entry on its right side. You credit it. Income also increases owner's equity, so increasing an income account also requires a credit.
So credit increases liabilities, capital, and income. Right side things.
Exactly. Debit increases A and E. Credit increases L, I, and C. That's the golden rule.
Okay, let's test this. A member pays their $1,000 annual dues in cash. Walk me through the debit and credit.
Perfect example. 2 things happen. First, the club's cash goes up. Cash is an asset. How do we increase an asset?
A debit. Left side.
Correct. So debit cash for $1,000. Second, the club has earned membership revenue. Revenue is income. How do we increase income?
Credit it. Right side?
You got it.
Right.
So credit membership revenue for $1,000. See, $1,000 debit, $1,000 credit. The equation stays balanced.
Okay, I think I'm getting it. What about, say we buy a brand new golf cart for $10,000 and we pay for it right away using the club's cash?
Good one. This involves only asset accounts. First, you get a new asset, the golf cart. How do you increase an asset?
Debit. So debit golf carts for $10,000.
Perfect. But you paid with cash, so your cash account goes down. Cash is also an asset. How do you decrease an asset?
If debit increases it, then credit must decrease it.
Exactly. You do the opposite. So you credit cash for $10,000. Again, $10,000 debit, golf cart's up. $10,000 credit, cash down. The total assets didn't change, just the mix. Balance maintained.
Okay. So once we figure out the debit and credit for a transaction, where does that information go first?
The very first place it's recorded is in the journal. Think of the journal as the chronological diary of the business.
Day by day.
Day by day, transaction by transaction, you log the date, the accounts involved, the debit amount, and the equal credit amount. It's the book of original entry.
Then what happens to those journal entries?
They get posted. That means they're copied or transferred from the journal to the ledger.
And the ledger's different how?
If the journal is the diary, the ledger is like the organized filing cabinet. The ledger has a separate page or T account for every single account in the chart of accounts. Cash, accounts payable, food sales, etc.
So all the cash debits and credits from the journal get summarized on the cash page in the ledger.
Precisely. Posting allows you to group all the activity for one specific account together. By adding up all the debits and subtracting all the credits posted to that account's page in the ledger, you can calculate its final current balance.
Okay, journal first, chronological,
Yeah.
then ledger, categorical. Is there a final check step internally?
Yes, there is. Before preparing the main financial reports, accountants usually prepare a trial balance.
Trial balance, what does that do?
It's basically an internal check to make sure the math worked out.
Yeah.
You list every single account from the ledger and its final balance, either a debit balance or a credit balance. Then you total up all the debit balances and total up all the credit balances. If the total debits equal the total credits, the trial balance is in balance. It proves that the double entry mechanics were followed correctly throughout the process. The books are, arithmetically at least, balanced. Hashtag the final scorecards reporting.
So this whole system, Alice, COA, journal, ledger, trial balance, churns out a ton of detailed data. But ultimately, that data gets boiled down into the main reports that people outside the accounting department actually see, right? What are the two big ones?
The two primary financial statements are, first, the profit and loss account, which is also commonly called the income statement.
Okay, P&L or income statement, what does that show?
It measures the club's financial performance, its profitability over a specific period of time, like for the month of June, or the third quarter, or the entire year. It focuses only on the revenue and expense accounts from our Alice model.
And you mentioned something important earlier. Revenue and expense accounts are temporary. Why is that detail so critical here?
It's fundamental to how accounting cycles work year after year. They're temporary accounts because their job is just to measure performance for that one specific period.
Okay.
At the end of the accounting year, these accounts are formally closed. That means their balances are reset to zero.
Wiped clean.
Wiped clean, yes. And the net result, the total revenue minus total expenses for that year, which is the profit or loss, is then transferred out of these temporary accounts and moved into the capital account on the other main report. This lets you start the next year fresh, ready to measure the new year's performance from scratch.
So the P&L results feed directly into the other report, which is
The balance sheet, sometimes called the statement of financial position.
the balance sheet. And unlike the P&L's focus on a period, the balance sheet is different, isn't it?
Very different in that respect. The balance sheet provides a snapshot of the company's financial position, what it owns and what it owes at one specific point in time, like as of December 31st.
The photo versus the movie analogy again.
Exactly. And it only uses the permanent accounts from Alice: assets, liabilities, and capital, A, L, and C. These accounts are never closed or zeroed out. Their balances carry forward from one year to the next, accumulating over the life of the business.
And I assume the structure of the balance sheet directly reflects that core accounting equation we started with.
Absolutely. It is the accounting equation laid out. Typically, assets, the uses of funds, which usually have debit balances, are listed on the left side or the top half.
Okay.
And liabilities plus capital, the sources of those funds, which usually have credit balances, are listed on the right side or the bottom half. And the fundamental rule is the total assets must equal the total liabilities plus capital. They have to balance, hence the name balance sheet.
Because that profit or loss from the P&L got transferred into capital, making sure it all ties together.
Precisely. It's a closed loop. Hashtag tag outro.
Wow. Okay, so we went from the absolute basics, what even is accounting, all the way through the organizing principles, the mechanics of debit and credit, and how it culminates in those two key reports, the P&L and the balance sheet. You, listening, now have the vocabulary, the blueprint.
You really do. You have the framework. But here's one final, really important insight, building on that trial balance point. Remember how we said it proves the debits equal the credits?
Yeah, the arithmetic check.
Well, it only proves arithmetic accuracy. The books can balance perfectly on a trial balance, but still be wrong in reality.
How so?
Think about it. What if a transaction was just missed entirely, never recorded? The debits and credits would still balance, but the accounts would be wrong. Or what if you accidentally posted a transaction twice? Debits and credits still balance, but it's wrong. Or maybe you debited office supplies when you should have debited food inventory.
Ah, right. The math works, but the substance is off.
Exactly. The trial balance won't catch those kinds of errors. It's necessary, but not sufficient for clean books.
That's such a critical point. It brings us back to that idea of a superpower. Knowing the language is step one, but true understanding means looking beyond just the balanced numbers.
It requires critical thinking about what the numbers represent in the real world.
So here's a final thought for you to chew on. Since the trial balance, and even the final reports, only tell part of the story, the numeric part, if you were looking at your own business idea, or maybe someone else's, what external measures, things beyond just the balanced books, would you look at to verify its true operational health? What tells you if things are really working, not just arithmetically correct?
Something to think about. Go use your superpower.
Thanks for diving deep with us today. We'll see you next time.